Hi, everybody. It's Tuesday and it's close of business. We've got a whopper for you today. Today is Oilfield Service Day, and not just any oilfield service day. We've got with us David Batt from Kimberlite, who's going to take us through what his company does and show you massive amounts of data on what today's oil and gas companies are telling us the future looks like. And we've also got John Daniel with us. John is a longtime Simmons research analyst who recently started his own company, Daniel Energy Partners. And so we're excited to hear about Daniel's new adventures, particularly his activities in basins and going out and talking to people in the field and really seeing what's going on. So welcome to you both. Guys, let's get this party started while John and David stretch and get ready for their segment. Let me start with you, Mike. A lot of green on the screen today, not just in energy. Talk to us, brother. What's happening?
Well, yeah, today was an interesting day, a little bit of green, a little bit of red. Where most of the activity today was centered around was the Liberty deal. A lot of enthusiasm for that deal, and we'll see how things work out. I think the one thing I want to talk about today is, what's going on with energy, what's going on with the equities. You've seen crude oil hold up over the last 4 or 5 weeks, but energy equities not. And the question that everyone's asking is, what is going on here? If you look at the crude oil strip and the XOP, they tend to be highly correlated, 95% correlated, and that correlation is broken down over the last 4 or 5 weeks. And I think a lot of that is just because these momentum stocks, the Zooms of the world, the Apples, the Teslas of the world, just keep consuming mind share and just consuming capital. And energy being a cyclical commodity is just getting dollars taken away from it. So there is a decoupling going on, even though the fundamentals, they're not great right now, but they're still not bad. Into 21, they look pretty good to us. So that's one thing that's, going on right now. And so we just got to get through that here. Like I said, the fundamentals don't look too bad. What do we have coming up over the next couple of weeks? Next week, we have a Barclays Energy Conference. I think we're going to have guys that are going to be able to talk about, hey, what happened with the Liberty merger today, whether we're going to see more of that going forward, what's going on with the E&Ps. They're going to have to look people in the face and say, hey, this is what we're doing with capital discipline. What we've been telling you is going to come true. What we're planning in the second half is not going to be higher spending. It's going to be probably at or lower spending. So next week's going to be an interesting week in energy and see how things play out here. But, interest is starting to increase a little bit from value guys because these guys are really talking good stories and we're seeing some mergers happen. So, when we look at, as we go into 21, it's going to be a little bit choppy, but we're still setting up for, I think, a pretty good 21 for energy sector.
Mike, I know that I think I saw that Goldman was out with a revised price forecast end of year 45 for this year. Anybody else out with revised forecasts? Why is the sentiment ticking up on oil?
I just think that couple things. I think from a demand standpoint, I think what Goldman is talking about is vaccines coming out, and guess what? Demand is going to inflect because of that. And also what we're seeing in the U.S. E&Ps, they're not going to be spending into next year. So we're going to have a supply and demand imbalance into next year, which means the back end of the curve is probably going to need to come up. And I think that's what Goldman's talking about, is looking at a $55 type commodity for next year, which isn't too far from what we're thinking.
And are volumes light so far? I know this tends to be a quiet week in terms of activity.
Yeah, volumes are pretty light. We're seeing that across our trade desk as well.
So let's jump now to Matt Portillo, our head of research. Matt, what's on your mind today?
Yeah, Maynard, I think you hit on a couple of topics that have been really front and center with us and clients over the last 2 weeks. We've definitely seen an uptick in value long-only accounts, kind of starting to scratch the surface again across a number of different subsectors within energy. Most of our incomings are still oriented towards midstream and upstream. I think part of that is because the upstream business models are starting to become a bit more investable with the changes around capital allocation going forward, as well as fairly robust free cash flow yields. If you look at the upstream sector in 2021, most of the companies in our coverage are going to have free cash flow yields to equity in that 10 to 15% range. And as that crude price continues to improve, more and more of that capital will likely find its way back into shareholders' pockets, which is constructive. I think on the midstream side, there's a little bit of tepid optimism. really being driven by the fact that you've got a fairly stable business model. Capital budgets have been slashed into 2021, which actually frees up more free cash flow. And it's going to allow companies to pay down more debt, which is a big focus for midstream investors. The one other subsegment that we've been getting interest in is in refining. However, I would say on the refining side, there's a little bit less optimism than we're seeing in the other two subsectors. Really has a lot to do with where global refining cracks are today, a bit of a glut in the product market at the moment, and some downside risks to the back half of the year. So the good thing is we're seeing an uptick in investor interest. I think it's going to take a little bit more time for clients to continue to kind of buy into these equities. But at the end of the day, as Mike mentioned, there's more optimism around the crude curve as we move out into 2021 and 2022. TPH is still expecting kind of a $50 to $60 crude price by 2022, really going to be dependent on the demand recovery. And I think that's more aligned with where the buy side is today. And when you start to underwrite that in the equities at the moment, they look quite cheap on a relative value perspective, especially given the pullback we've seen on a lot of the stocks relative to the commodity.
Thanks, Matt. George O'Leary, we've got a oilfield service party going here today. You're head of OFS research. Give us some big themes that we can chew on as we start talking with David and John.
Yeah, so we're fairly fresh off Q2 20 earnings season, which we saw results largely pan out better than most folks expected for the coverage universe, which was clearly a surprise because you saw OFS stocks outperform. The OIH was up about 20+% over the course of earnings season from what Halliburton reported through and CSM reported. Beats were largely driven on the cost side more so than the revenue side, but you also saw strong free cash flow generation. That was the good. The flip side of that is, on average, about 120% of that free cash flow generation came from working capital wind down as revenues decline. For most companies, you're going to see that bounce back the other way as revenues eventually increase. So the concern is, who's going to see that unwind in the most pronounced fashion and see that free cash flow generation go the other way versus who's able to keep things like DSOs in better shape, run lower inventories on a consistent basis, and maybe spend less in CapEx. So those capital light entities may pan out to be better investments long term. And so since those beats and that outperformance, you've really seen the oilfield services stocks fade. And from a thematic standpoint, to your original question, what do we see and what are clients asking us about? One, M&A is clearly a hot topic. You've seen a number of transactions over the last few years across upstream broadly, not just in oilfield services, but on the E&P side. As there are fewer E&Ps, the logic goes, we probably need to see fewer services players, and we have too many as it sits today. So who's next on the M&A front is a frequent question that's come up. And if you look at U.S. onshore activity, that's probably the next biggest bucket that people want to chat about, as it looks like international activity will continue to grind lower for the next little while, and we'll see activity in the Middle East trend lower in the back half. How many frac spreads do we need to keep U.S. onshore production on the crude oil front flat in the 2021 period? That looks like where our upstream brethren are going to set their CapEx budgets to try to keep exit-to-exit production flat. And how many rigs will we need to run in that scenario? And you have to take the DUC count into account. While we disagree with the EIA's assessment of DUCs, we think they have as many as twice as many DUCs as are actually out there in the market. There are clearly a lot of wells that can be completed that don't need to be drilled, given rig count has been much stickier than frac spread count. So what that leads us to, after digging in on that topic, is somewhere in between 145 and 185 total U.S. onshore frac spreads running, and somewhere between 360 and 460 U.S. onshore rigs running. Obviously, a lot of moving parts and assumptions here, so that range is very wide. But that just makes sense given all the moving parts, frac efficiencies, well productivity, which basins will be producing, et cetera. So that's our best guess. We're officially forecasting 150 to 170 frac spreads for next year and 365 land rigs. The land rigs are at the lower end because of that drilled but uncompleted well phenomenon. So that kind of sets the stage. We sit somewhere between 105 to 110 active frac spreads today. So there's a ways to climb up on the U.S. onshore frac spread side, and the same goes for rig count. At some point, rig count needs to trough out and start bouncing higher. Frac spread count since the June timeframe has been migrating higher on a month-over-month basis. Rigs are still finding their way to the bottom, but it actually gets better from here for service. The struggle is exactly what Matt laid out. If U.S. onshore E&Ps target a flat production program, even if crude oil prices march higher, you don't get the traditional rebound in onshore activity that we would have expected. Once upon a time, we were running north of 400 U.S. onshore frac spreads, call that the June-July timeframe in 2018. We don't see us getting back there at any point based on our current crude oil price forecast, but it does get better from here. Things like M&A and attrition, which are clearly hot topics today, will help that market heal. And there are still plenty of jewels within the OFS space. You just have to pick your spots and be creative with it and be thoughtful about it.
All right, great. Thanks, George. Well, speaking of jewels, I think David, I noticed had to do a little research. Kimberlite, that's a diamond name, and so we'll be getting some jewels from you as we get into the discussion. As we wrap up here, Colin, I'm struck by the fact that we're 8 to 10 minutes in and nobody has mentioned the election or ESG. Maybe today is a ESG election holiday as we talk about OFS. What's on your mind, big fella?
Yeah, this is just an oil zone today. You know, here at the end of August, we had the annual Jackson Hole conference from the Federal Reserve. So in the land of macro, we had a pretty big development, but it's been one that's been expected. So I think people are at risk of glossing over it. And specifically, it is the Fed's pivot to say its new policy is if it undershoots its inflation target of 2%, measured by the PCE metric, not PCE core to be specific, not CPI, then it will now aim to overshoot that level so that there's some sort of balancing effect over time. Now, again, that seems not like such a big deal, but it's actually crucially important for everything we're about to talk about for OFS. And so I just wanted to share a couple of the slides that we've been showing to our TPH commodities clients this week to help quantify exactly what's going on here. So here is the Fed's preferred measure of core inflation. As I said, PCE core, so it pulls out energy and food, and that number is at 1.25, CPI is at 1, and you can see going back to the Great Recession, the Fed has not really achieved its target. We've been underneath that 2.0% threshold for most of this expansion. And looking forward, now that we have this policy of overshooting to compensate for undershooting, I really want to make just a couple of points. One, it has been a long time since anybody in the oil patch or anywhere else has seen real inflation. Now, no one is expecting to see the kind of inflation that we saw in the 1970s with these double-digit numbers. But just to give you a little bit of the math here, looking back to 1995, the frequency of a 2% inflation number was only about 1/4 of the time, 23.6%. To be specific. The average was 1.7%. So to balance out the next 25 years against the 25 that just happened, we're actually targeting a 2.3% number. And that's the average. We asked the question, well, what was the standard deviation of those inflation readings looking back 25 years? And let's create an upper bound and a lower bound for what might happen looking out over the next 25 years. We should be expecting to see about 3.15% core inflation on the upper bound and about 1.5% on the lower bound. And remember, we're at about 1.25 today. So the floor is above where we are now. And this is core inflation. So what does it mean for frac sand prices or anything that's in the real economy? You got to tack on another 3 percentage points to start getting to averages that are more what we think of as CPI inflation. So we are about to enter a world that is anywhere to 5 to 7% year-over-year inflation on the high end. And it's been quite a while, obviously, since we've seen that. Now, I think we've done a pretty good job in recent months of talking on this program about the anticipatory nature of gold and other commodities seeing this coming inflation. And so what you're looking at here on the x-axis is the five-year forward inflation expectations rate as measured by the Federal Reserve, and commodity prices on the y-axis. And I'm just going to quickly show you what's happening in a number of commodities. This is spot gold, and you can see that there's a pretty strong relationship here. 88% of the variance can be explained by a simple linear equation. You can see that this goes from a March 20 low of about a 1.08% inflation expectations rate to about 1.81 today, and that's been associated with a very sharp upward movement in the spot gold price. We've talked before about how silver is very much like gold, but with a higher beta. Same story, very strong relationship between the price of the commodity and the inflation expectations. Bitcoin, it's like precious metals on steroids. We get even more of a beta to that underlying story. Now, when we bring it to our world, into the land of energy, and we ask, okay, is that 5-year forward WTI swap beginning to show any kind of nervousness about inflation or inflation expectations? And the answer is yes, but not quite as much as we're seeing in gold. In fact, the slope of that curve for the gold line is at about 48. The slope on the TI curve is at about 20. So you can see there that spot gold has been much more responsive as a vehicle for these rising inflation expectations relative to crude. When we look at gas, same story. The physical world is seeing this coming inflation, but not quite yet responding to it. And that gives you some of the explanation for why equities are not yet responding in the way that they will when these inflation expectations hit the oil patch more forcefully. And when you look particularly at this 100 line that we've marked here in red, we're still not back to where prices were in the 5-year forward market as of January. But it's not true for all commodities, even in the physical industrial world. Copper is beginning to show more of a precious metals attention to inflation expectations that we're not yet seeing in gas and WTI. And pretty simple explanation here. Remember, copper is more of a capex-oriented commodity, more tied to investment, infrastructure, real estate, buildings, and so on, whereas petroleum, of course, is more tied to consumption of oil products. Think jet fuel and gasoline, and gas, of course, is more attuned to those consumer economics. So bottom line, putting all those pieces together, we could show all 6 of these commodities across the 2 different tenors on this single chart. And what becomes readily apparent is that the spot vehicles are reflecting financial paper economy attention to the inflation that has a very high probability of coming. You can see the rank order is Bitcoin is most sensitive, then silver, then gold. Because of liquidity and historical access issues, gold tends to be the preference for institutional investors to express this view. But we have no doubt that Bitcoin will continue to be preferred by those hedge funds that want to get a little extra vig. On the bottom, you can see that the longer dated vehicles, the 5-year swaps in TI, gas, and copper, are reflecting a real economy drag that we're all aware of. But all of these commodities, all 6, have responded to the rising inflation expectations. So while it may not yet be readily apparent in OFS, it may not be readily apparent at certain points of these forward curves, it is in the system. And so just to wrap up, we've talked again on Close of Business about what investors are seeing when they decide where to allocate capital. And Mike already said, and our research team already pointed out, that as the dollars get pulled from perhaps energy equities to go into tech or alternative vehicles, we put these precious metal futures more on that recipient of capital side of the ledger as opposed to being a funder of those positions. And you can see today, as of September 1st, we're getting right back to $2,000 in gold. Silver is up 143% since March in the prompt. And in Bitcoin, we see more than a 200% advance. I mentioned potato chips when we had Admiral McRaven on the program just a little bit over a month ago. Here's the update we just got this week. Potato chip prices in the United States are now up 17% year over year. And one reason why we like this retail commodity as an indicator of inflation is because we all have total indifference to the price. Very few people really are pushing aside the small bag of potato chips when they buy a sandwich. Often it's just combined into some sort of sandwich platter price. Very few people could tell you exactly what those prices are within a nickel or a dime for the bag. So this is a great indication of the indifference to that marginal dollar. And you can see we're starting to look a lot like we did in the summer of 2008. We are not seeing that in the cash price for jet fuel or other commodities that are still languishing against COVID economics. And what's a little bit alarming is take a look at the cash price of jet fuel in the Netherlands at the ARA hub. That to me looks like we're getting a little bit of a hook down. So that could be a warning sign here in the very near term, just to keep an eye on some of the oil product markets. Producers too are seeing on the margin that combination of a little bit of fraying of demand and better opportunity to hedge. We're seeing in the forward 2021 puts, better put premium from the perspective of the producers. This is a combination of time decay in those futures contracts and also just intrinsic value as you get that slow drift upward in the forward curve. Not particularly large amount of open interest, but definitely moving in the right direction to get those hedges on. And then finally, I just wanted to end on this scatter diagram, which we've shown before. It's a bit of a busy chart, but it does nothing more than relay the prompt price of NYMEX natural gas against the managed money net position. And for those bulls out there in natural gas, this is very powerful evidence that something very important is changing in natural gas toward a bullish stance. Look at the bottom of the chart. As we've discussed before, back in February, this was a market where the managed money net position had a max short at the 15-year low in price. We say that this has been an open interest that's been swimming below the surface. You can see it there around the zero line with those maroon dots. And look where we got to as of August 25th. That 132,000 net length position at a $2.54 price has snapped us back into the regime that we were in basically from January 2015. As somebody who has traded these markets, both futures and options, I can tell you that is a buy signal. And we are starting to see little stirrings of interest, not only here in the prompt contract, but also in the 2021 to 2025 contracts. Running the math, the threshold for $3 sits historically at about 142,000 contracts of that length. We're only 10,000 away. So I would keep very close attention on what is happening in natural gas, because even though it has been lagging what we've seen happening in gold and silver and Bitcoin, it may very well be giving us a signal that something is changing here on the margin.
Don, that's great. It just it makes me think the world, needs to get back on planes and stop eating so many potato chips. This is just not healthy.
Well, maybe if we get past the election and we do have a vaccine, I think things can happen in a hurry. And, we have unleashed a genie that has been stuck in the bottle for 25 years. Now, Maynard, you and I were in markets in the 90s, and we remember, what it felt like then. And we were even around in the 70s for that matter. It's been a long time since this kind of monetary inflation has been in these markets, OFS and otherwise. And so we want to stress very loudly that 2020, from the perspective of 2050, is going to be a really important historical bright line that marks a change from the fixed income world of 1982 to 2020 to the world that is about to happen 2020 to 2050. And I realize having 30 and 50-year views is somewhat ridiculous, but this is the cusp of something very different in the land of macro.
All right, awesome. Well, David and John, let's turn to you guys. David, maybe just to get us started, Kimberlite is well-known, well-regarded to so many of us, but I'm not sure all of our viewers are familiar with what you guys do and how extensively you do it. Could I ask you to start with just telling us a little bit about Kimberlite so people have a sense of it?
Sure, Maynard. Be glad to do that. I'm glad to be with you on Close of Business here today. I think I may just share a couple of screens here to maybe share a little bit more about Kimberlite, Maynard. But each year we personally interview about 3,000 E&P operators or users globally. And that's about a $20,000 endeavor that we take on each year. But through these very comprehensive personal interviews that we conduct through phone interviews at Kimberlite Research, we're able to prepare a fairly comprehensive set of research across formation evaluation, drilling, completion, production, subsea, and even pipeline integrity. You're talking to the geologists, drilling engineers, completion engineers, production engineers and subsea engineers. And when we conduct these personal interviews across the globe, and about 50% of our research is North America, about 50% is international, we're really tracking operator sentiment and future plans for activity to drill, complete, produce. We're also tracking technology needs, gaps in technology adoption trends. And we're also tracking the oil field service suppliers that are being used and how they're performing so we can benchmark the competitive landscape. And so it's a series of comprehensive reports that we update annually for most of these product lines.
That's a great kickoff. So I guess the question, and maybe we can get John in on this too, is what are the trends? We heard some of the things that George and Colin were talking about, but what are the trends you guys are seeing amongst operators, customers, anywhere you see them? It could be technology or anything else. So John, maybe I'll just start with you, get you in on this conversation.
Yeah, no, and thank you for having me as well. Unlike David, I'm very micro focused, 100% US.
Well, we got micro and macro. This is perfect.
100% US land. If my philosophy is if I can't drive there, I don't want to cover it. And so
home for dinner, I think, is the strategy.
A lot of Dairy Queen and a lot of barbecue. But so I guess, I launched my firm back in April. But I spend most of my time out in the field. And I think since April, I've been to Midland, I guess 6 times. I've driven up to North Dakota. I've been up to East Texas a bunch, just trying to get around. And one of the things that jumped out at me early on, I guess probably back in May, was the desire by E&Ps to get out there and start bringing stuff back to work, which we've now seen through Q2 earnings, but the need to get the DUCs completed and really wanting to capitalize on low service costs. That was a consistent message, like, hey, it's not going to get any better than this. We want to get back to work. And so my crystal ball is probably not as good as George's, but I'm in the ballpark in terms of what he's looking at from rig count frac crew next year. My tally on working crews is just a little bit higher, but it's neither here nor there. I'm around 125. But I continue to hear anecdotes of people saying we're going to bring more stuff back to work. Just talked to a frac company today that's going to deploy another 2 fleets. But what they're also telling me is, hey, be careful. We might be slowing down in November and December again. A lot of the work is short-term spot work. Someone just trying to get a few wells done. And so we don't think it holds. And then to be determined into next year, where it goes.
And one thing I've been curious about, so you've been out in the field, how are, just the folks who are out there working, what's the attitude out there? How are folks holding up? There's a lot of stress in the system right now.
It changes quickly. Several weeks back, as I was out seeing some of the private operators, there was a little bit more optimism for 2021. Out there about a week and a half ago, the message was people were sort of bringing me down saying, hey, this borrowing-based redetermination season, I'd be curious Matt's views on it. But they all, it happens twice a year, so it's not it's not a surprise. But there was a much greater fear factor about what would happen, and therefore a negative implication to their spend in 2021. If the borrowing base gets cut, now they got to, find a way to pay off that debt. Is it through asset sales? How are you going to bridge that gap? And so that was a concern, a big concern.
Matt, let me ask you to finish that thought. What are you hearing from your companies on borrowing bases and bank attitudes about lending?
Yeah, I think the public market is in pretty healthy shape here. If you look at, again, back to the public companies, which do control a pretty sizable portion of the rig count, looking out into 2021 to kind of stabilize at a maintenance capital program. Most of the operators we cover can do that at $35 to $40 a barrel, depending on if you're covering the dividend or not. But essentially at strip pricing at 45, everyone's in healthy shape and actually generating a pretty healthy chunk of free cash flow. I think on the private side, it's still a bit of a concern, especially given the roll-off of production this year. The reduction in the PDP profile will be more meaningful, but then you may have a revision to the commodity price decks, which were set at exceedingly low levels at the trough of the market. So net, I think the concerns around the borrowing base are still real. The desire to lend to the sector is fairly constrained, especially given the lack of capital markets activity, which is impacting the bank's desire to lend. But the debt markets are opening up, and we've seen a pretty significant healing in the debt markets. You saw a couple of the higher quality, lower levered E&Ps essentially term out debt to 2030 at a 2% yield. You saw some of the more levered upstream companies that have profiles in that 4 to 5 times leverage range actually be able to tap the debt market even a few months ago at an 8.5% rate and have subsequently come back in and tap the market at closer to 6%. So while the financing on the bank side may still be constrained, I think the fact that the debt markets have started to heal is improving that confidence in terms of being able to prosecute these programs going forward.
David, let's jump back into the results of all those interviews you're doing annually. We'd love to hear some more about some of the things you're hearing, whether it's technology or activity. I know there's quite a few topics you cover.
Sure, Maynard. We recently published some reports based on talking to drilling engineers on drilling services and most recently completion engineers for hydraulic fracturing. And this week and next week, we'll be publishing reports for artificial lift systems as it relates to production engineers. And, one of the things that we track is operator sentiment. And you're probably familiar with this diffusion index, where 50 is no change in activity and above 50 is market expansion and below 50 is market contraction. And, one of the things that you detect and notice that's quite different about this downturn is in the 2014-15-16 downturn, Maynard, you may recall it took 20 months before we reached market bottom in the summer of 16. And I really can't tell you how many times in the last downturn of 14, 15, 16, how many times we were asked, are we there yet? I don't know if you recall that or not, but there was a lot of predictions about, when are we going to get there? And it took 20 months. The difference about this downturn is, we reached bottom fast and hard in a period of about 75 days. And operator sentiment for the drillers moved from, in large part, from a period of expansion to heavy contraction, and with an indices of like 7.5 on the sentiment indices for drilling engineers in North America land. When you take a look at the completion engineers in the hydraulic fracturing report, hydraulic fracturing had already entered contraction mode back in 19, just due to all the drilling and completion efficiencies that George and others have talked about here today, leading to a significant overcapacitization in the market where we were able to accomplish more with less. And then as the pandemic hit in the beginning of 2020, sentiment for completion and hydraulic fracturing continued to deteriorate down to about an index of about 19. Correspondingly with that, you'll see the frac crews that we talked about go from 350 at the beginning of the year, bottomed out down to about 45 frac spreads at the back in May, and we've already back up to 75 or 80. What's interesting, though, and we talk about this quite often in the industry, Maynard, is how a little bit more resilient the production side of the OFS is. And what you see is the sentiment amongst the production engineers and production managers are indeed in contraction mode, particularly in North America land. But with the sentiment indices of 41, you can clearly see that the sentiment's not quite as dire as it is for the drilling engineers and for the completion market. But when you look ahead to 2021, we just published this chart, I guess, a week or so ago based on 192 interviews in U.S. land and Canada, Maynard. And what we find here is, looking ahead into 2021, even though the operator budgets are not firmly approved and put into place, but the sentiment and expectations of the operators is to drill about 15.4% more wells in 2021 versus 2020. And when you translate this into actual number of wells and rigs required, it really does dial in quite nicely with what George shared earlier, where this translates into about a mid 350 drilling rig count in 2021 at current price logic. And so, but most of the activity, as you can see, is heavily Permian Basin driven, whereas all the other non-Permian basins in the U.S. are usually sub 10% at the current moment in time. But I think, John, you picked up on this on your trip to Permian. One of the things that we've picked up that's different right now is, you would think in this dire overcapacitization market, you would expect just about every E&P operator saying, hey, we expect discounts. But what we find with the completion engineers for hydraulic fracturing services is there's about 45% of the E&P operators that say, look, this path to traditional discounts has reached the end of the road because the oilfield service companies, they really don't have anything else to give. And so there really seems to be this trend towards flight to quality, Maynard, that we see out there in the marketplace, where E&P operators are really starting to seek out the best performing suppliers that they can proactively collaborate to identify cost out opportunities and to identify additional operational synergies in the field. And so that's a big trend that we see, not just with the completion engineers, but we also see it with the drilling engineers as well when we produce the drilling reports.
Let me just ask, John, are you hearing similar things about how people are thinking about their service providers?
I was just going to chime in and add into the question, Maynard, just to kind of reinforce it. There's a popular perception out there, at least in the public investing community. And John, I'm sure you're very familiar with this from your time at Simmons. David, I'm sure you have discussions with folks about this as well, but that there really isn't any differentiated performance out there in the field between these service providers, whether it's wireline providers, pressure pumping, coiled tubing, or drilling. I would disagree with that generally, that there is some differentiation. And I think, David, your flight to quality comment alluded to that, but maybe starting with John and then flowing on to David, could you guys talk about what you hear from E&Ps and various parties out in the oil patch about differentiated performance and whether that really exists?
No, I absolutely do think they see it. I won't name any names on this series, but as I've talked to completion engineers or the supply chain folks, they clearly have a preference. And I would say the one thing that jumped out at me in this year, and I know you said we weren't going to talk about ESG, but
well, we can. I mean, how can you not?
You have to talk about it because for the first time, as people were telling me that through their RFP process, a lot of them are asking providers, tell us what you have in terms of dual fuel capability, whether it's tier 2, tier 4 electric. And I'm aware of at least one E&P that basically said, if you're not tier 4 DGB or electric, we're not interested. And I think that will be a trend, a big trend as we go forward. Yeah,
there's no question. I think it's kind of an inside joke here because Bradley found on Twitter, somebody said, my gosh, close of business, all it is climate change and ESG. When can we talk about oil and gas again? Or something like that. But David, let you keep rolling here. You had a good slide up there about cutting costs and how to do it.
Sure. I'll pick up real quick on whether or not there's differentiation. One of the interesting things when we interview the E&P operators, Maynard, and we ask them if hydraulic fracturing is a commodity, 62% of them say, yes, we think hydraulic fracturing is becoming a commodity, right? But when you ask them to rate the performance of the suppliers with whom they use on a scale of 1 to 10 on these 7 performance measures, like responsiveness to needs, equipment quality, reliability, competency of field service personnel, technical support, availability, completion efficiency, and pricing competitiveness, similar to what John illuminated just a minute ago on his trip to Permian, is there's a big variance in the performance that you see between the worst performing hydraulic fracturing service suppliers and the best performing hydraulic fracturing service suppliers. And so, even though operators may tell you anecdotally that, we think that a lot of them perform the same, when you statistically start to look at the swath of ratings that are received, there's quite a big variance. And so, we oftentimes will plot the performance of the suppliers across the x-axis against pricing competitiveness or pricing strategies on the y-axis. And you can see all these different dots or different suppliers that we've redacted for today, highlights that there's a big variance in performance in the Permian Basin between some of the worst performing frac suppliers and some of the better performing frac suppliers. And as you move around by basin, be it the Permian or the Eagle Ford or the Bakken or the Rockies, and I think I have other basins as well, you'll start to see that there's a fair amount of performance differentiation that does occur, and it makes it really hard for the oil field service companies to sometimes demonstrate their capabilities when the E&P operators may be familiar with only using one supplier or 2 suppliers, and they really don't know if the E&P operators how these other suppliers perform. So we do see quite a bit of variance in the performance of the suppliers that we track.
Maybe just to add on to that, I do think this is becoming a much bigger focus for the C-suite management teams in energy. one of the healthy things that has occurred is we've moved away from NAV conversations, and there's a lot more focus on margin expansion. And I think as the resource broadly across the U.S. has been fairly well delineated, operators are kind of finding their strides on spacing design. What they're really focused on is driving incremental capital efficiency improvements through really best-in-class service. And that has been a big focus and shift, I think, as the industry has taken a pause here in 2019 coming into 2020, renewing a focus on getting best-in-class service so that they can really drive margin enhancement over time as a partnership with their service providers, but at the same time being able to get that cost structure down over hundreds and hundreds of wells is actually pretty accretive to the corporate free cash flow profiles going forward. So while the industry up until kind of 2017, 2018 was really focused on productivity gains and inventory and NAV, I think you're now seeing a much healthier market dynamic and balance around best-in-class service, and that best-in-class service helping drive margin enhancement through the capital cycle as we move forward over the next few years.
So Matt, let me just ask you, do you spend time asking the companies you cover in upstream which service providers they're using, and do you draw conclusions from who they're using and who they're not? Has it become something like that, or am I overstating it?
I think in 2019, what you really saw, particularly in the Permian, was a big focus on the discrepancy between operators and the D&C cost per foot to drill and complete wells. And as that scrutiny came down from an analysis perspective, I think a lot of companies internally started to really focus on who their service providers were and really the benefits of that relationship from a historical perspective versus potentially shifting capacity to those best-in-class operators that may be some of the smaller players in the basin, but may actually give you better service. And so that's been a big focus. I'd say over the last 12 months, you've seen a lot more investor interest and corporate interest in comping out those metrics and actually trying to drive down the cost structure through that best-in-class service line.
From my point of view, I think we're lucky on the oilfield services side of the equation at TPH to have a very strong upstream E&P team here and a good dialogue with that E&P team. I think often at some of our competitors, guys kind of function in silos and one hand doesn't talk to the other when really clearly oilfield services works directly alongside and for the E&Ps. And so to the extent I have a question about how some service provider is perceived, Matt and team will go ahead and ask that question. And you do see some E&Ps that have shifted service providers on purpose in chasing better completion efficiencies. Some vertically integrated E&Ps who sold off their services assets and chosen completion services players or oilfield services players to run those assets better than they do. So I do think it's important for us, and to the extent we need help with it, if we reach out to Matt can get very good color from the E&P coverage. So that's a super helpful thing for our franchise and great for the OFS research team.
Well, the only thing wrong with this conversation is we could go on forever. I'm having a fantastic time. I'll try, I hate to, but I'll try to kind of wrap it up and ask in particular David and John a couple of questions. John, I'll start with you, but next year is looking like, we might have a decent oil price. The E&Ps are committing themselves to spending conservatively. Oilfield service looks like there's differentiation going on, and the competition is around customer service and technology. Mm-hmm. How do you think it shapes up, and what are you thinking about next year as you spend your time? What are the issues? I know you're going to be going to the basins, doing your field trips, but what's on your radar is just the things to watch and most interesting topics for Daniel Energy Partners.
Well, the thing I'm most focused on today, and I've written about the last couple of weeks, is the concept of power generation in the field. And it feels to me that you're going to start seeing evidence of power shifting from the actual frac company to either rental companies or E&P companies looking to provide their own power. And so what would that mean? It might just mean that you see a change in the design of the traditional frac trailer, where no longer is it the radiator, engine, transmission, and a power end, but it might be something completely different where it's just a power end, electric motor VFD, and someone else besides the frac companies providing the power. So I think you're going to see more electric fleets be built over the next, probably over the next year. But that's something that really jumped out to me in the most recent discussions, was the appetite for people to really dig into that. And if you think about the opportunities, and I've not modeled this because I'm not smart enough, but what if the E&P company actually had the power and could use that for the frac fleet and the D&C operations, and then you have that residual to provide the power for ongoing operations production? And what's that opportunity set if you could ever sell it into the grid? And this is very, very early days, and I don't expect radical announcements, in terms of major investments by tons of people anytime soon. But this is where I'm getting calls.
Interesting. So. That's a great one. David, how about you? And I apologize, David, because you got so much data and so many topics that you've asked the world about. I mean, this thing is a teaser to call your Kimberlite representative and try to get a hold of all that data. But what would you tell us you're focused on going into next year?
Well, the key trends that we clearly see for the industry, be it U.S. land and elsewhere, are clearly more along the digital lines and data analytics and remote operations. These things are going to stick post-pandemic and on the other side as we come out the other side of this downturn. As John pointed out, the operators in U.S. land they really prefer dual fuel over electric by a 2-to-1 margin, just due to their comfort level and track record of performance of dual fuel being around. But you look at the continued completion and drilling efficiencies that we've enjoyed not only in the past several years, but we expect that to continue to be able to accomplish more with less. And so if you dial back to 2014, when we had 2,000 drilling rigs and 8 million barrels of oil production, and now we're at 780 drilling rigs at the beginning of this year, 13 million barrels of oil daily production. I think you're going to continue to see the operators continue to achieve more with less. Leveraging the data analytics and digitization and the technologies, be it quick connects and monoline systems, as well as these dual fuel and electric systems to drive costs down. Remote operations is absolutely huge, and data analytics is continuing to advance. And you'll see much more of that taking place. We do see flight to quality, and we also see that even though some OFS companies believe the markets have really just gone into a commoditized market, we actually are able to better segment these markets between performance-driven markets versus price commodity-driven markets versus service-driven markets. And we'll continue to track that, because I think that lends a lot of insight as to where investment's going to go.
Hey, David, could I impose on you? I was looking at your slides yesterday when we were pre-gaming a little, and you've got a slide on the switch to the cloud that the industry is making. I think that would be a fun place to close and draw some of your comments from that. I'll confess, I found that one fascinating.
When we move to the cloud, what we find is that the operators are really not migrating to the cloud quite as aggressively as they would like to. When we talk to the earth science community, only about 22% were accessing applications from the cloud, and that was only up very marginally from 17% in 2018, just 2 years ago. Now, they have very big appetites that by 2 years from now, 2022, we'll have 54% of E&P operators accessing cloud for G&G software applications. But, if you look back to 2018, they're only accessing 7% of their applications from the cloud, and that only increased marginally to 10%. And in large measure, the reason why that's happening is in order to move to a cloud-based solution, the E&P operators have to pay a premium to their providers. And when they look at their cost structure on this next slide, they find that particularly amongst the majors and independents, nearly 50% of their cost to support their operations is fixed costs with their own IT infrastructure. And so to move to a completely vendor-managed solution, they would need to really displace this internal cost, because the new vendor is going to provide their IT support. But since they're not really ready to prepare to let go of this cost internally, what we're really finding is that their incremental data needs is, rather than budgeting for an additional 10 or 50 or 100 or 500 servers to their their storage capacity, they're moving incremental growth to the cloud. I mean, certainly the value props are there. I mean, remote operations, faster startup. We see all the various benefits of migrating to the cloud, but until they're ready to let go of their internal IT costs that currently support their infrastructure, because they will pay a premium to move to the cloud. And that's to be expected, because you're not just paying for software and related maintenance, you're paying for the vendor to provide a complete managed solution for you up there.
Awesome. Well, look, let's wrap it up there. I just want to say a special thank you to David Batt and John Daniel. You guys are fantastic leaders and great contributors and great friends at TPH. So thanks for joining us. Thanks to the team. And thank you to all of you out there. We'll see you next week.